When people talk about trading, they often imagine charts flashing red and green, strategies whispered in private rooms, or secret indicators that promise endless wealth. But the real secret, the one that separates the top 1% of traders from the other 99%, has nothing to do with hidden formulas or overnight breakthroughs. It lies in psychology. The mind of an elite trader is not shaped by luck or chance, but by a cultivated way of seeing the markets and themselves. This mindset is built over years, and it becomes the foundation upon which every decision rests. Without the right psychological framework, even the most sophisticated strategy collapses under the weight of fear, greed, and impatience. The average trader enters the market hungry for profits, often imagining that quick wins and short-term gains will carry them to the top. This hunger blinds them, making them reactive rather than proactive. Their trading is dominated by emotion, chasing when the market rises, panicking when it falls, exiting too early when profits appear, and holding too long when losses build. In contrast, the psychology of the elite trader is anchored in self-awareness. They do not fight the market, they do not chase it, they align themselves with its flow. They recognize that the true opponent is not other traders, but their own impulses. One of the defining qualities of the top 1% is detachment. They detach from the need for each trade to be a winner. They know that a single trade does not define their journey, and this liberates them from the pressure most traders feel. Detachment does not mean indifference, it means clarity. It allows them to see risk without fear, opportunity without greed, and outcomes without personal judgment. This kind of psychological discipline transforms trading from a battlefield into a measured practice, where execution is not tainted by hope or despair. Elite traders also cultivate resilience. Markets are inherently uncertain, and uncertainty can crush the unprepared mind. For the majority, a series of losing trades triggers doubt, frustration, and sometimes desperation. They begin to question their ability, adjust strategies impulsively, or double down on risky bets in an attempt to recover. The psychology of an elite trader interprets loss differently. Losses are not failures, they are feedback from the market, signals that must be studied rather than feared. This reframe protects their confidence and preserves their consistency. Resilience allows them to continue executing their process even when outcomes temporarily defy expectations. Another critical psychological trait is patience. The average trader craves action. They sit in front of the screen and feel the urge to do something, even when conditions are unclear. This constant need for movement drains capital and clouds judgment. The elite trader understands that waiting is a form of action. They are willing to observe quietly until their system provides a clear signal. Patience is not passive. It is a weapon. It ensures that energy, capital, and attention are invested only when probabilities are in their favor. Patience separates the reckless gambler from the precise strategist. Self-control plays an equally vital role. In trading, temptations are endless. The temptation to risk more after a win, to revenge trade after a loss, to abandon a tested strategy for a shiny new one. Without self-control, even a profitable system becomes useless. Elite traders approach their routines like athletes preparing for competition. They follow their rules with unwavering commitment, no matter how strong the emotional pull to deviate. Self-control ensures that discipline survives where excitement would normally take over. It is this discipline that creates the consistency required to build wealth over years rather than months. The psychology of the top 1% is also built on humility. Markets are bigger than any individual. They are not conquered, they are navigated. The elite trader accepts that they will be wrong often, and this acceptance shields them from ego-driven decisions. Instead of seeking to prove themselves right, they seek to preserve capital and stay aligned with the truth of the market. Humility allows them to admit mistakes quickly, cut losses without hesitation, and avoid the trap of defending a bad trade because pride is at stake. This humility paradoxically strengthens their confidence, because their identity is not tied to being right, but to being adaptable. Clarity of vision sets them apart as well. While most traders are obsessed with the outcome of the next trade, elite traders view every decision within the framework of a long-term vision. They know what they are building toward, and that bigger picture keeps them from being derailed by short-term noise. Their psychology is future-oriented but grounded in the present. They do not allow today's market turbulence to define tomorrow's goals. This clarity keeps them steady in storms where others are swept away. At the core of all this is emotional neutrality. The elite trader trains their mind to remain balanced whether facing gains or losses. While the average trader celebrates wins with reckless enthusiasm and mourns losses with crushing despair, the top 1% respond with equilibrium. Wins are validation of process, not a license for arrogance. Losses are information, not reasons for self-destruction. This neutrality protects them from the wild emotional swings that sabotage decision-making. It ensures that the mind remains clear, sharp, and capable of seeing reality as it is, not as emotions distort it. The psychology of elite traders, then, is not about avoiding emotion altogether but mastering it. It is about creating a mental framework where resilience, patience, humility, and discipline are the default state. This mindset is what transforms an ordinary trader into someone capable of standing among the top. The journey into trading often begins with excitement. Charts flicker, prices move in real time, and the thrill of possibility electrifies the air. For beginners, every trade feels like a roll of the dice, every outcome a rush of adrenaline. They imagine themselves striking it big in moments, capturing wealth at lightning speed, and living in the rhythm of constant highs. But excitement is the very thing that blinds them. It fuels overtrading, reckless entries, impulsive exits, and a cycle of euphoria followed by despair. Excitement is unsustainable. It burns bright, then fades into fatigue and losses. Discipline, on the other hand, is sustainable. It does not depend on market movement, but on self-mastery. The traders who climb into the top 1% understand that to succeed in this game, one must replace the hunger for excitement with the steady presence of discipline. Discipline in trading begins with structure. Unlike the majority who log in search for action, elite traders begin their day with routines. They wake not to gamble, but to follow a system. They review their strategies, analyze their setups, and only move when their rules allow. Their discipline removes randomness from their decisions. It is not that they lack emotion, but that they build barriers against emotion's destructive power. A disciplined trader may watch the same chart for hours without pressing a single button, waiting for alignment between strategy and market. The undisciplined one cannot sit still. The need to act overtakes clarity, and their capital is consumed not by the market but by their lack of control. The allure of excitement is that it feels rewarding in the moment. Winning a trade through impulse feels validating as if intuition is guiding the hand. But this illusion is fragile. What works once fails the next time, and the trader begins to chase the same feeling, like a gambler returning to the table. Excitement thrives on randomness, and randomness destroys consistency. Discipline, however, thrives on repetition. It is grounded in doing the same correct thing over and over again, regardless of the temporary outcome. Discipline does not celebrate one lucky win. It values the process that produces 1,000 steady trades over time. Another aspect of discipline is the ability to say no. The average trader believes trading means being in the market constantly, always doing something. The disciplined trader understands that sometimes the most powerful decision is not to act. They say no to impulsive entries, no to trades outside their plan, no to risking more than their rules allow. Saying no requires strength, because every fiber of the emotional mind screams to get involved. But discipline is about listening to logic, not emotion. Over time, this ability to refuse temptation builds trust in one's own process. The trader begins to rely on rules rather than instincts clouded by desire. Discipline also manifests in risk control. When excitement rules, traders often bet big, risking too much on a single move, because they believe the outcome will be in their favor. This hunger for excitement magnifies both gains and losses. But inevitably, it is the losses that dominate. The disciplined trader approaches risk with precision. They know exactly how much of their capital is exposed at any given moment, and they never deviate from that structure. This isn't about avoiding risk, but about shaping it, controlling it, ensuring survival in the game for decades rather than months. Discipline transforms risk from a threat into a manageable tool. Patience is another branch of discipline. Excitement demands immediacy. It wants action now, results now, gratification now. Patience is the antidote, the silent strength that prevents recklessness. The disciplined trader waits for setups to mature, for conditions to align, for the market to reveal its hand. They do not force trades because they know forcing trades is forcing losses. Patience allows them to stand still when others rush in, and it is often the stillness that protects them from ruin. The market rewards those who wait for high-quality opportunities, not those who chase every flicker of price. In the long run, discipline creates consistency, and consistency is what builds wealth. Excitement may produce short bursts of success, but it cannot be repeated with stability. Discipline creates patterns, habits, and behaviors that compound over time. It transforms trading from a hobby of highs and lows into a professional craft. Each trade is not a gamble, but a deliberate step in a structured journey. The trader becomes less concerned with the outcome of today and more invested in the discipline of following their plan. Perhaps the greatest shift is psychological. When excitement governs, the trader is a slave to their emotions, rising with wins, collapsing with losses. When discipline governs, emotions lose their grip. The trader becomes steady, calm, unaffected by the chaos of the moment. Discipline provides freedom because it eliminates the mental roller coaster of fear and greed. It anchors the mind in clarity, where decisions are not dictated by adrenaline, but by carefully chosen rules. This is the paradox of trading. What feels most exciting is usually what destroys growth, and what feels most boring routine, discipline, patience, is what creates success. The top 1% of traders learn to embrace that boredom, to value it, to love it. They know that the real excitement is not found in the rush of a single trade, but in the slow, disciplined journey that takes them where few ever reach. In trading, most people treat risk management as a side rule, something that exists to protect them when things go wrong. They see it as a safety net or a tool they can use when necessary, much like an emergency exit in a building. But this view is precisely why the majority of traders fail to sustain themselves in the markets. For the elite, those who rise into the top 1%, risk management is not a fallback strategy. It is their identity. It defines every choice they make, every trade they enter, every position they hold. It is not an accessory to trading. It is the very fabric of their approach. Without it, no mindset, no strategy, no amount of intelligence can secure survival in the chaos of financial markets. The average trader often sees risk management as an inconvenience. They might calculate stop losses, set position sizes, or talk about protecting their capital. But when emotions rise, those rules are the first to break. They may double down after a losing trade, ignore their limits when they feel confident, or move their stops further away to avoid accepting a loss. In their minds, risk management is a restriction, something that gets in the way of bigger gains. This mindset confuses control with limitation. Elite traders know the truth. Risk management is not limiting. It is empowering. It ensures longevity, stability, and the ability to stay in the game long enough for skill and strategy to pay off. When risk management becomes identity, it shapes how the trader sees themselves. They no longer identify as someone chasing profit. Instead, they see themselves as guardians of capital. Every dollar is treated as a soldier in a larger army, and their mission is not to throw soldiers recklessly into battle, but to deploy them with precision, conserving strength while advancing strategically. This shift in identity transforms trading from a game of chance into a discipline of preservation. The elite trader measures success not by how much they gain in one day, but by how well they protect their capital across thousands of trades. Embedded within this identity is the principle of position sizing. Most traders focus on the potential profit of a trade, dreaming about what they could earn if the market moves in their favor. Elite traders, guided by risk identity, focus first on what they stand to lose. Before they enter, they ask not how much they can gain, but how much their capital can absorb if the market moves against them. Their position sizes are calculated with discipline, not with hope. This approach ensures that no single trade, no matter how promising, has the power to destroy them. They accept that markets are uncertain and that losses are inevitable. By making risk identity, they protect themselves from devastation and allow compounding to work in their favor. A key psychological transformation occurs here as well. Traders who see risk management as tactic still feel the emotional sting of losses deeply. Every stop hit feels like failure. Every drawdown feels like defeat. But when risk management is identity, those losses are no longer personal. They are structural. The trader does not resist them, does not argue with them, does not fear them. They are simply part of the framework, as natural and expected as expenses are to a business. This neutrality toward loss is one of the most powerful mental advantages of the elite. It keeps them from revenge trading, from doubling risk, from emotional spirals that end careers. Risk identity also extends beyond numbers and rules. It becomes a lifestyle. Elite traders control not only their positions but also their environment. They manage their time, their focus, their routines with the same precision. They avoid distractions that could impair judgment because they know that risk is not only in the market but also in their own habits. They see their trading life as an ecosystem where every choice either supports or endangers their capital. To them, risk management is not just a strategy applied at the chart, it is the way they live and breathe. Another layer of this identity is the acceptance of uncertainty. Many traders cling to the illusion of certainty, believing that with enough analysis, they can predict outcomes flawlessly. This illusion makes them vulnerable, because when markets move unpredictably, they are shaken to the core. The elite trader builds their entire identity around uncertainty. They do not pretend to know the future, they prepare for it. Risk management becomes the shield that protects them from the unknown. By embracing uncertainty, they gain flexibility, allowing them to adjust, adapt, and pivot without ego. This mindset also ensures scalability. A trader who does not internalize risk may succeed temporarily with small amounts of capital. But when the stakes rise, their lack of discipline becomes catastrophic. The elite, however, can scale from a small account to a large one because their risk identity does not change with size. The same rules, the same discipline, the same frameworks apply, whether they are trading thousands or millions. This consistency is what allows them to grow steadily, without self-destruction. Ultimately, the difference between tactic and identity is longevity. A tactic can be broken, ignored, or abandoned under pressure. Identity cannot. When risk management becomes who you are as a trader, it is not something you remember to apply. It is something you cannot imagine trading without. It is stitched into the DNA of every action you take, guiding you with the quiet strength of permanence. This is what makes the top 1% untouchable in the long game of trading. For while others gamble, markets are living entities, unpredictable in nature, and constantly shifting between fear and greed. For the average trader, these movements are a source of instability, pushing emotions to the forefront of every decision. When prices rise, greed takes hold, convincing them that they are invincible and that greater profits are inevitable. When prices fall, fear grips them, forcing rushed exits, hesitation, and panic-driven mistakes. This cycle repeats endlessly, draining capital and confidence. What separates the elite traders, the top 1%, is not a secret strategy hidden from the masses, but their ability to master emotions when uncertainty dominates. Emotional mastery is the silent edge that allows them to remain steady while others crumble under pressure. The essence of emotional mastery is the ability to see reality as it is without distortion. Most traders interpret the market through the lens of their feelings. A sudden dip in price feels like a personal threat. A sudden surge feels like a personal victory. These emotional interpretations cloud judgment, creating a false version of the market that does not exist. Elite traders train themselves to detach from these distortions. They view price action not as personal affirmation or rejection, but as neutral data. To them, the market is not attacking them nor rewarding them. It simply is. By mastering this neutrality, they make decisions that are aligned with truth rather than impulsive. Uncertainty is unavoidable. No trader, no matter how skilled, can predict with absolute certainty where the market will go in the next minute, hour, or day. The amateur clings to the illusion of control, believing that enough analysis will eliminate uncertainty. But this illusion cracks as soon as markets behave unexpectedly and their emotional stability collapses with it. Elite traders embrace uncertainty as a permanent companion. They do not resist it, they plan for it. Emotional mastery allows them to remain calm in the face of surprise, adapting without panic and adjusting without hesitation. By preparing their mind to coexist with uncertainty, they remove the shock factor that destabilizes others. One of the greatest emotional challenges is dealing with losses. Every trader experiences them, but the interpretation of loss differs drastically between the ordinary and the elite. To the average trader, loss feels like personal failure, an attack on their skill and identity. It stirs frustration, shame, and the desire for revenge against the market. This emotional spiral often leads to reckless decisions that multiply the damage. The elite trader, however, reframes loss as information. A loss is not a verdict. but a message. It shows what worked, what didn't, and where adjustments are needed. Emotional mastery transforms loss into feedback rather than failure, allowing progress instead of paralysis. Wins present their own emotional trap. Success often breeds overconfidence, a subtle but dangerous form of emotional imbalance. Traders who ride the high of a big win may feel untouchable, leading them to break rules, take unnecessary risks, and expose themselves to greater danger. Emotional mastery requires humility even in victory. The top traders celebrate their wins not with ego but with analysis. They ask why the trade worked, how it aligned with their system, and whether it was skill or luck. By keeping their emotions in check during wins, they prevent success from becoming the seed of downfall. Another element of emotional mastery is patience in uncertainty. Markets often move sideways, producing little clarity and testing the trader's endurance. In these moments, emotions whisper that something must be done. Impatience pushes traders to enter low-quality trades just to feel engaged. Emotional mastery resists this pull. The elite trader waits calmly, recognizing that inaction can be as powerful as action. They know that the urge to force trades comes from emotion, not logic, and so they cultivate patience as a shield. This ability to wait without emotional strain keeps their capital safe until conditions align with their system. Focus and concentration also play a role in emotional mastery. Distractions, whether external or internal, amplify emotional responses. The trader who is half-focused is more likely to panic when the unexpected happens because their mind has not been conditioned for clarity. Elite traders discipline their focus. They control their environment, remove unnecessary noise, and approach the market with deliberate attention. This mental state strengthens their ability to manage emotions because clarity of focus reduces the room for panic, doubt, and impulsive decisions. Underlying all of this is self-awareness. Emotional mastery begins with knowing one's own triggers, weaknesses, and psychological patterns. Every trader has them. Fear of missing out, fear of loss, need for validation, or thrill-seeking tendencies. Those who fail never acknowledge these triggers. They fight blindly against themselves. Elite traders confront them directly. They study their behavior, recognize the moments when emotion creeps in, and develop systems to counteract those impulses. Emotional mastery is not about eliminating emotions entirely, but about managing them with awareness and discipline. Finally, emotional mastery in uncertain markets is about stability under pressure. The market will always produce shocks, volatility, and conditions that test even the most seasoned. The difference lies in response. Ordinary traders let uncertainty rule them, turning decisions into reactions. Elite traders master uncertainty by mastering themselves. They remain calm, centered, and methodical, navigating storms with the same steadiness they bring to clear skies. For most traders, the market is nothing more than a pursuit of profit. They log in with the singular goal of making money quickly, driven by the obsession of turning small amounts into large sums in record time. This obsession creates a narrow vision where every action is measured solely by immediate financial gain. Yet this very focus is the root of failure. Profits are not something a trader can directly control. They are the byproduct of following a consistent, repeatable process. Elite traders, those who break into the top 1%, shift their entire focus away from chasing profit and onto perfecting their process. They know that in the long run, process guarantees survival, consistency, and growth, while profit obsession blinds and destroys. Process in trading is about structure, repetition, and discipline. It is the framework that governs analysis, entries, risk management, and exits. It does not change on a whim, nor does it bend to the emotions of the moment. For the elite trader, each day begins not with the thought of how much money they can make, but with how well they can execute their process. They review charts, follow their preset rules, and approach each potential trade with the same discipline, whether the market looks tempting or uncertain. This shift in focus ensures that every decision is guided by method, not by the erratic pull of greed. Profit obsession, on the other hand, creates fragility. Traders consumed by the desire for quick returns constantly change their strategies, jumping from one method to another, chasing the illusion of a perfect formula that will deliver riches overnight. This restless pursuit leaves them without consistency, and inconsistency is fatal in the markets. A process-driven trader, by contrast, understands that no system produces constant wins. Losses are inevitable, but as long as the process is sound, the long-term trajectory remains upward. This mindset creates resilience, the ability to withstand temporary setbacks without abandoning discipline. Focusing on process also reduces emotional volatility. When profit is the goal, every trade becomes an emotional gamble. A winning trade sparks euphoria and overconfidence, while a losing trade brings despair and doubt. The trader becomes trapped on a mental roller coaster, unable to think clearly. The process-focused trader avoids this cycle. They judge themselves not by whether a trade was profitable, but by whether it was executed correctly, according to their plan. This reframing provides stability, because even a losing trade can be seen as a success if it was carried out in alignment with the process. Emotional balance follows naturally, and emotional balance is the cornerstone of longevity in trading. Another advantage of process over profit obsession is compounding. Traders obsessed with profit often risk too much in pursuit of bigger gains, and this recklessness leads to devastating losses that erase months of progress in a single move. Process-driven traders, however, prioritize steady, incremental growth. They risk only what their system allows, compound their capital slowly, and understand that wealth in trading is built not in weeks but in years. Their identity becomes that of builders rather than gamblers, and the compounding effect of their discipline eventually separates them from the masses. The process-centered mindset also fosters learning. Profit obsession blinds traders to the lessons hidden within the market because they only care about the outcome. If they win, they celebrate without understanding why. If they lose, they despair without examining what went wrong. The elite trader, however, studies every trade as feedback. Wins are analyzed for alignment with process, and losses are dissected to refine methods. This constant refinement strengthens the process itself, making it sharper, more efficient, and more adaptable over time. In this way, the focus on process transforms every market interaction into an opportunity for growth. Patience is another byproduct of process. When profits are the obsession, traders feel an urgency to act constantly, to always be in the market, to always chase movement. This urgency leads to overtrading, poor setups, and capital erosion. A process-driven trader knows that waiting is part of the plan. They understand that the market will present opportunities when the time is right, and until then, their job is to observe. This patience prevents unnecessary losses and ensures that capital is deployed only when probabilities align with their system. The obsession with profit is fueled by ego. Many traders enter the markets to prove something to themselves, to others, to society. They want to show they are smart enough, bold enough, lucky enough to beat the system. This ego-driven obsession often pushes them into reckless behavior. The elite trader dissolves ego by anchoring identity in process. They no longer need to prove anything through outcomes. They need only to follow their system. Success becomes less about external validation and more about internal consistency. This shift protects them from the traps of arrogance after wins and desperation after losses. Ultimately, the distinction between process and profit obsession determines survival. Those who chase money burn out quickly, falling victim to emotional extremes, inconsistency, and reckless risk. Those who embrace process gain stability, resilience, and long-term growth. Profits flow naturally to them as the inevitable result of disciplined execution, but they are never the focus. By prioritizing process, elite traders build a foundation that withstands uncertainty, adapts to change, and produces results over time without the destructive weight of obsession. Trading attracts many people with promises of fast results, stories of instant millionaires, and images of rapid success. This creates a culture where most approach the market with a short-term mentality, believing they can outsmart time itself and compress years of experience into days of gains. But those who remain, those who climb into the ranks of the top 1%, view the market through a different lens. For them, trading is not a sprint, but a lifelong journey. Their mindset is not about today's win or tomorrow's loss. It is about building resilience, skill, and wealth that endures across decades. The long-game mindset is what separates the fleeting trader from the enduring professional. The short-term obsession comes with predictable patterns. Traders focus on immediate returns, trying to double accounts in weeks or turn small sums into large fortunes overnight. In doing so, they push too hard, risk too much, and inevitably break under the weight of impatience. They are enslaved to the need for immediate gratification. The elite trader, by contrast, trains their mind to accept slow, steady compounding. They know that meaningful wealth is not the result of one spectacular trade, but the accumulation of disciplined decisions over years. By extending their horizon, they free themselves from the desperation that drives most traders to ruin. A long game mindset is grounded in perspective. Losses, which devastate the average trader, are seen by the elite as small chapters in a larger story. They understand that a single day, or even a single year, does not define their career. This perspective prevents overreaction. When others quit after setbacks, those with the long view continue forward, confident that consistency will ultimately outweigh temporary obstacles. Their vision stretches far beyond the moment, and this allows them to navigate storms with calmness rather than panic. Patience is the natural companion of this mindset. The long game trader knows that opportunities are endless and that the market will always provide new chances tomorrow, next week, and next year. They are not consumed by the fear of missing out because they know that chasing every move undermines their process. Instead, they wait for conditions to align with their system, sometimes sitting on the sidelines for long stretches. This patience, born from the long game perspective, ensures that their capital is preserved and only invested when probabilities are favorable. Another key aspect of the long game mindset is the prioritization of growth over perfection. Traders trapped in the short term demand flawless outcomes. Every loss feels catastrophic, every mistake intolerable. The long game trader accepts imperfection as part of evolution. They see mistakes as stepping stones rather than dead ends, and they commit to lifelong learning. Every year becomes another layer of wisdom added to their craft. This dedication to incremental improvement ensures that their skill sharpens with time, while those who demand immediate mastery burn out and disappear. Compounding is at the heart of the long game. The average trader underestimates the power of small, steady gains. They dismiss modest profits in pursuit of larger, riskier wins. But the elite understand that compounding transforms the ordinary into the extraordinary when time is allowed to work. They focus on protecting capital, achieving consistent returns, and letting growth build upon itself. Over decades, this compounding effect creates results that short-term traders can never achieve, no matter how spectacular their wins may appear in the moment. The long game mindset also requires humility in the face of the market's vastness. Those who believe they can conquer it quickly approach with arrogance. But arrogance does not last in trading. The market humbles everyone eventually. The elite accept this truth from the beginning. They do not fight to dominate the market in the short term. They aim to adapt, to endure, and to align themselves with its rhythm across time. This humility shields them from reckless behavior and keeps them grounded in their process. Even after years of success, consistency becomes more valuable than intensity when viewed through the lens of decades. A short-term trader may push aggressively, risking everything in pursuit of rapid results. But this intensity is unsustainable. It leads to burnout, both financial and emotional. The long-game trader values consistency above all. Small, repeatable actions, followed with discipline, performed day after day. This consistency compounds not only capital, but also confidence, resilience, and clarity. It becomes a rhythm, a way of life, rather than a series of desperate attempts at quick success. Perhaps the most defining feature of the long game mindset is emotional stability. When a trader ties their entire sense of worth to immediate outcomes, they are constantly vulnerable to the emotional extremes of euphoria and despair. This volatility destroys decision-making. By stretching their focus into decades, elite traders detach their identity from short-term outcomes. They no longer need to prove themselves through today's chart. Their stability allows them to think clearly, remain calm under pressure, and maintain discipline even in chaotic markets. In this stability lies their true advantage, for while others burn out, they remain steady, accumulating the rewards that only time can provide.